Hello everyone and welcome to today's major markets update for Wednesday, November 9. And thank you for listening. Thank you for being a valued premium member. Yesterday it was only Tuesday, but I was already exhausted, especially of course with the cryptocurrencies crashing. But luckily the financial stock markets are kind of moving along reasonably well with what has been anticipated over the last few days. Though I do want to say that we are currently in a bear market, and those are indeed mentally draining. Why? Because of the many twists and turns you will see and have seen as well, and that it makes it always very hard to forecast. 2021, we had a long ending diagonal, for example, and all we pretty much had to do was see if the diagonal would extend, yes or no. They always can tag on another ABC, same as a impulse to the upside or downside can add length. Doesn't have to stall at 161.8% for the third wave, can go to 261.8. That's pretty much the only problem we have in a bull market. Upside is, is unlimited essentially. But with bear markets, we're dealing with this continuous overlapping ABCs left and right, which is really mentally challenging. And that's why a lot of people give up, because the trading doesn't work anymore as it used to be. There's no more dip buying, so to say. If it does, it works for a little while, and then the market changes tune again. So that's why you always have to remember why work is around 70% reliable and 95% accurate. There's just no other way. And all we can do is use the evidence-based medical approach. When the evidence changes, we change accordingly, anticipate, monitor, and adjust. And that's why I wanted to start with this nice little scene here from Anchorman. 60% of the time, it works every time. That's pretty much what you can get out of the markets. I always like it when things are chugging along really nice, forecast works, but then I also start to get a little anxious because I know you cannot forecast everything all the time. That would be too much to ask. That is impossible. That's not how the markets work. Markets throw always a proverbial curveball. So even if we see people nailing it for a while, at some point they are not nailing it anymore, and vice versa. When you're out of sync, you get back into sync, etc. So just really be aware of this fact of the environment we're currently in, and it is not a strong, high certainty environment. But we can still make, of course, a lot from this. And I know I've been talking a lot, said anything about the markets, but it is always good to paint the things in the right perspective. There's more to markets than just price action. It's also a bit philosophical, etc. Anyway, so here we have the NASDAQ100. It still has the possibility for this last fifth wave lower to about potentially as low as 9100, but could stall at around 9000 if it wants to. In that case, the NASDAQ100 would, in my humble opinion, do a ending diagonal, wave 5 of 5. So we still have this path available to us. If we break above yesterday's high, I think we're starting to move towards the alternative. And let's see if I can find the chart. Give me 1 second. And that is this one, of course, the ABC higher. Okay. So please note where the NASDAQ is. It is pretty much where it was in early October. Compare that to where the Dow Jones is. It is where it was in August. Major difference, major difference. This is quite the bifurcated market. So that brings me to the Dow Jones. We could have done potentially 5 waves up already. Then we'll just ignore some of the smaller scribbles that have taken place from the rally here at last week's low into yesterday's high. It counts well. I don't want to put too much emphasis sometimes on the smaller time frame because it increases the odds of being wrong. But as my dear friend Pretzel also points out, we can still see an A, and B, and a C, which goes a little bit lower, and then we rally. As you can see, A, B, C. That would make for a more complex fourth wave. Okay, it wouldn't surprise me if that is the case. Okay, So that is still very possible. We go probably a little bit lower. It doesn't have to necessarily, and that would then be a flat A, B, C. So we can have, as shown here, that would then be alternative A there. That should then be in green because it's a minor wave. Then yesterday's high was a B wave for a irregular, potentially expanded flat C wave. So Alt B, and then we're gonna get Alt C, right? That's what we're looking for, somewhere around there. Now we can do some relationship between A, B, and C. So this is the length of A, B stalled there. So yesterday's high, so wave C can target anything like here, okay? And then that is 4. And from there, we then get the rally, okay? So please keep that in mind. Fourth waves tend to be quite whipsawy, most of the time flats. So that would fit with this pattern because we haven't seen really 5 waves up into yesterday's high. I agree. It looks much better as 3. So then we have an A, B, C potentially for wave A, B, C for wave B, and then we should see a 5-wave decline for wave C. Please keep that in mind. Okay, again, here's the hourly chart. Also, as shown here, it's hard for me to make this 5 waves up. That brings me to the semiconductors. Okay, semiconductor still looks good here for this 1-2 setup. See no reason to change my tune unless we break below last week's low. Then this wave B/2 might be subdividing also in a flat analog to the Dow Jones. So again, because price is so overlapping, right, we're back here to where we were last week. Look at this mess. This hasn't gone anywhere in September, which in a way is also a good sign given all the bad economic news that we have so far digested. Markets are still in a not too bad a place. They could have been a lot lower, honestly, so to say. So we can have still this 1-2 setup. I keep it on the chart, and if we break below the wave 2 box, then it is time to consider this as a A1, A of B2, B of B2, C of C2. That's the alternative view. And here is then the S&P 500. It's so far been ticking off all the boxes, the A box, the B box, and should now be in the C box. Well, it's not in the C box, but in wave C. To the target zones as shown. See no reason to change my tune. I'll change my tune if we break below the October low. Then something else is going on and we might see a waterfall decline. But for now, that is not my preferred point of view. I'll stick to my guns for as long as the guns are shooting straight. And so far, they're shooting straight. So I see no reason to stop shooting. And that brings me then to the IWM. IWM is behaving accordingly as well. The A wave almost to the ideal target zone here. B wave right in the ideal target zone, so should now be in wave C. So will we see a negative response to the CPI data tomorrow? Probably. But as you know, I most of the time don't really go into if a market should go up or down based on news events, be it either economic news or geopolitical news or financial news, whatever it is. So this path remains the same. We don't really need to know the news to know this path is going to fill itself in. And so far it's done it exactly. I like it that we topped yesterday in the ideal B wave target zone, dropped below it today. So this looks really good. And this is really all I have for today. And as you can see, a lot of these indexes are in different patterns and paths. Break below the October 13th low for the S&P 500 and the IWM and the other ones. That's bad. We could see a waterfall decline. But for now, this looks still good. So I see no reason to change my tune. I'm well aware of the bearish wave counts where they produce a 1-2 setup. However, based on the Dow Jones, that seems a little less likely, right? The Dow Jones has this ABC path, as Pretzel's shown here as well, ABC, okay? So it's very possible. So otherwise, we have a problem, so to say, with the Dow Jones has so far risen quite a lot, and it's very hard to see it go into a third wave at the moment. Anyway, We also know that the Dow Jones continues to struggle with trend lines, with the 200-day moving average. So again, please be aware that we are in a bear market, which are emotionally very draining. This has been one of the toughest years in the financial markets, both from a returns point of view, both from a price action point of view. So if you can stomach this, you can stomach anything. And I think we're going to have a much easier 2023 than we had in 2022. I still expect the end of year rally. I see no reason why not to, but we have to go through the daily machinations. So the Dow Jones, ABC, I'll take it, wouldn't be surprised. NASDAQ100 ending diagonal wave 5, wouldn't be surprised. Semiconductors can do a more complex red wave B2, otherwise it's a 1-2 setup as shown. S&P500 ABC still on track, see no reason to change my tune unless we break below, I would say the warning is 3600, and that can then target 3500, and below that it's going to be 3200s. Similarly for the IWM, we have to remain in these target zones. If not, then I think we'll see another impulsive decline. With that, thank you so much for listening. Take care, trade safe, hang in there, and remember, 60% of the time, it works every time. Haven't seen this movie, please do so. It's quite funny. And if anything, these days, please watch a funny movie, put a smile on our face. It's difficult enough as it is already. Take care, trade safe. See you all on Friday. Bye.